So there's a lot we're going to talk about here in this video. We got some big data today. We have big data coming out tomorrow. We do have a couple of earnings as well throughout today and after hours and tomorrow that will also be important. But I do want you just to remind yourself, this does not matter compared to the jobs report. What we really want to see over the next 24 hours of data that we're going to get is how could this affect the non-farm payroll report on Friday? Is any of this data giving us a hint of weakness to come in that report? Because this Friday's BLS report is going to be the biggest catalyst for all of September. Forget about the Fed. This jobs report is more important than the Fed. And if they cut 25 basis points or 50 basis points. We got decisively bad data. This was bad news. Jolt's job openings, I don't know why it's doing that, came in at 7.673 million. The estimate was 8.09 million. So this was almost 400,000 job openings, less than expected. That's bad. As I've stated in prior videos, this Jolt's job openings report to me is more of a gauge of the economy more than it is the actual labor market. Because if you're a business, you're looking to hire a bunch of employees, you're doing great. You're probably far from considering layoffs at that point. Well, if you start to reduce your job openings, if collectively that is happening across, the US, then you're getting closer to the point of actually laying people off. Okay, during a boom cycle the last couple of years, companies look to hire a bunch of employees, and well, if business slows, they're gonna stop looking to hire employees and they're gonna start considering layoffs, right? So it's like we went up and now we're starting to come down. And this job openings number came in a lot lower than expected. This is not a good sign for the economy. Now, markets already know this doesn't matter. The data tomorrow really doesn't matter. It's all about Friday. And I think that's why we're going to get such a big move coming on Friday based on this jobs report. Now, we did get some news embedded in some of this data as well. Factory orders month over month came in at 5% positive. We were expecting 3.8% positive. Last month was negative 3.3%. So including last month's negative number, it's not that impressive, but it did beat the estimates. Factory orders excluding transportation came in at positive 0.4%. We were expecting negative 0.2%. That's good. That's better than expected, at least. You do have the Fed beige book as well at 2 p.m., although that doesn't tend to move the markets all too much. Tomorrow morning, we will get Challenger job cuts at 7:30 in the morning. At 8:15 a.m., we will get the ADP employment change. You're expecting that to come in at about 115,000 job ads. Initial jobless claims expected at 227,000. That would be down from 231,000 last week. Continuing jobless claims as well will come out, and ISM services PMI. The headline number is expected to weaken from 51.4 down to 51.2. So marginal weakness, really not a huge deal. Business activity expected to weaken, employment expected to weaken, new orders expected to weaken, and prices also expected to weaken. So slight weakening is not a big deal. But if we do get a bad number, if we see a lot of weakening, if services actually go negative and that is below 50, that would be a bigger problem for markets. And again, on Friday, non-farm payrolls, we're expecting around 120,000 to 160,000. There's some various different estimates on this. And really, I think we're closer to like 150,000, right? I don't think markets would be happy with 120,000 job ads. I don't. The unemployment rate, there's some various different estimates here as well. Some are expecting the unemployment rate will actually fall to 4.2%. Some are expecting it will stay the same at 4.3%. The issue will be is if the unemployment rate rises. If it rises at all, Wall Street's not going to like that. If it goes to 4.4%, that's bad. If it goes to 4.5% and jumps 0.2% like it did last month, that's where you potentially have a massive down day, like a 5, 6, 7% down day for the S&P would be possible if the labor market really did start to weaken in that kind of degree. I do think that is the big risk for markets heading throughout the next couple of days is if that jobs report does come in on the light side. It's also being reported that a Fed 50 basis point rate cut in September is now priced as more likely than a 25 basis point cut, short-term U.S. interest rate futures suggest. Which, as I've said before here on this channel, I'm not convinced a 50 basis point cut is going to be seen as good news if it's coming because of weak economic data. If we price in a 50 basis point cut because inflation's just really good, which yes, we will get another inflation report before September 18th, around September 11th or 12th. If that comes in really low and that's why we price in a 50 basis point cut, that's fine. That's great. But if we're getting bad data, bad JOLTS job openings, potentially bad ISM services PMIs tomorrow, a bad non-farm payroll number, I don't think a 50 basis point cut is going to be seen as good news. I don't think it really will matter what the Fed is doing for the first cut. Like, is that really going to matter? That's not going to save the economy. That's not going to do anything for the economy. From a generalized perspective, you're still going to have weakening, and you're still going to keep trend with whatever is going on. Kevin Gordon on X writes, wow, construction industry job openings rate fell to a new cycle low in July. 6-month drop, now negative 2.1 percentage points, which is the largest in history. So job openings in the construction sector have never fell 2% year over year before, and now they have. That's not a great sign for economic activity. Nick Timmerhouse writes on X, this is a labor market that isn't as tight as it was before the pandemic. Job openings declined further in July, and the ratio of job vacancies to unemployed workers dropped to 1.07, the lowest since 2018. Tom Lee and Fundstrat on X write, we are entering a tricky 8 weeks into Election Day. Watch the VIX as this signals if pain is front-loaded. Post-Labor Day, the S&P 500 started September with a 2% decline. This is the worst start since 2015, when you were negative 3%, and the 5th worst ever since 1928. So we're actually starting off September on a pretty rough note. Today, the S&P is down about 0.2%. Considering the JOLTS job opening number came in so bad today, this actually is a much better reaction in markets than what we probably should have asked for. Lance Roberts writes on X, the decline in the ISM inventories to order spread suggests further weakening in the manufacturing reports in the coming months. And as Lawrence McDonald on X writes, markets are speaking. U.S. yield curve turns positive for only the second time since 2022. This was according to Bloomberg. Actually, interesting here is you had bull steepeners of the last couple, recessions, right? Here, bull steepener, bull steepener, bull steepener, bull steepener, even in 2019. Now you have a bear steepener. It says here, a bear steepener can also represent a normalization of the yield curve as the market becomes more appreciative of economic strength. This can presage a positive backdrop for risk assets following its conclusion. Which that is certainly possible here. Like, if we don't go into a recession, if the Friday jobs report is good, I expect September is going to be a stupid strong month. And I think Tom Lee, I think a lot of people that are bearish on markets right now, they're going to be proven very wrong. It's going to come down to the jobs report. But if that sucker comes in bad, watch out below, because markets are going to have to price in a lot of recession risk quickly. And that's kind of what we seen on August 5th. And I would expect something similar to that. As far as earnings, we do have earnings from C3 AI, Hewlett Packard, ChargePoint, and Casey's today in after hours. Thursday pre-market, so tomorrow you're going to have NEO, Fuel Cell Energy, and Toro. And then in after hours tomorrow, you're going to have Broadcom, UiPath, Samsara, DocuSign, Planet, Braze, Zoomies, and Smartsheet. That report Friday pre-market, you're going to have Big Lots. I didn't even know they were still in business. The only one in my area closed down when I was little. I have two clips I want you to listen to, one of which is what Tom Lee shared on his X account, and well, it's from Mark Newton, that goes over the technical breakdown of our markets and what could be coming next. The next one is from Adam Parker, which you'll see on CNBC all the time. He's defensive on our markets. He's not super excited about where stocks are at. He thinks stocks probably need to go lower due to earnings expectations being so high and not coming down heading into 2025, with risks out there of a further slowdown. I mean, that makes sense. You should see earnings estimates come down a bit. And we haven't seen that yet. And I think that could be an interesting dynamic of the next couple of months, whether or not the economy is strong or it's not.
History, right? We look for patterns to see if they repeat themselves and that sort of thing. So as we look at the carnage that's happened over the course of the last day or so, in context of what happened in August, and in the broader context of what's been a nice bull run, what are you seeing in the S&P 500?
Thanks, Tom. Well, look, as you can see here, we've recovered almost the entire pullback from early August, and I think that's the important thing. Technology, which most say is undergoing real carnage, has snapped back. It was the third best performing sector, in the month of August. So we've really seen very little actual true damage outside of yesterday. We did break 55.50. We're down to levels, just above 5,500. This area near the open gap is going to be really important. That's 54.63 or so. So my thinking is, in the near term, we don't have enough information to say actually that it's going to be a larger decline as of now. We've seen yesterday, which came out of nowhere. We heard weak data out of China, of course. That caused interest rates to plummet. Dollar yen started to pull back. S&P and the NASDAQ broke very sharply. This is going to be the key for the S&P, 55.50 to 54.63 or so. So, not too much damage overall. A lot of this is technology based in terms of why markets aren't at new highs, similar to what this next chart will show, which is the equal-weighted S&P.
All right, so let's clear that and show the equal-weighted S&P 500, because you're saying that's that kind of more broadening type theme or trade that's been going on.
No, this is important for investors to know. Look, technology is 30% of the S&P, but as of last month, we had 5 sectors that made new all-time high closes on a monthly basis. We have technology, financials, healthcare, industrials, and utilities. And so that's really important, is that, on an equal-weighted basis, S&P made new all-time highs as of, the end of last month. And so, to think that you sell a market at new all-time highs, the odds to some extent are stacked against you. Momentum is still positive. Breadth is in very good shape. We have about 75% of all stocks above their 200-day moving average. That's important. Sentiment has gotten more optimistic, as might be expected. We're up 500 points in the S&P in about 3.5 weeks. However, it's not yet too enthusiastic, too complacent as of yet to say, well, this is the top. We're in September. And one other point,
yes,
in election years, September is actually not the worst month. We've always heard September is the worst month of the year. That's true historically. September actually can be better than October, which is actually a lot worse during years like this.
So what's interesting is you're telling us, despite the massive amount of damage done yesterday, we haven't seen enough technical damage to say that this is the beginning of anything deeper or darker in terms of a downturn.
100% correct. And a lot of that is because financials and healthcare, which combined are 25% of the S&P, both hit new all-time highs last week on an equal-weighted basis. We want to strip out all these large cap influencers that really affect the broader averages and look at an equal-weighted basis. Yes, technology is what everybody is still focused on. It makes a lot of sense. However, financials, healthcare, industrials, all working very, very well. Market breadth is good. It's not like 2007, where you had the majority of sectors that peaked in the month of May or June and the market turned down. So the breadth is not all that thin at new highs. It's actually very well supported.
Newton basically said what I've been saying for the last couple of days, that we won't know anything until Friday. The damage is not too far gone by any stretch of the imagination to, be doomed or destined for more downside. This gap that he's talking about here took place between August 14th and August 15th. The S&P went up 1.71% and gapped higher. That is on the SPY 548.56. If you stay above that, then you're gonna be doing okay. Like, if we get through Friday and we don't have a big drop and the non-farms come in good and we go higher, you're probably gonna have a really good September. Now, if we fall under this and start to fill the gap lower to about 545 or so, then we can start to talk about larger downside from here and the seasonals of September that may start to take over. I have a feeling, though, if that jobs report is bad, if that unemployment rate goes up, we're going to blow past these levels to the downside. I mean, we could theoretically fall like 5% plus in a single day. So from that perspective, I mean, Friday, you could wake up at 523. You could wake up with a really, really bad day. Or things could be good and you could go up 2+%. So I think you really want to watch the markets, especially tomorrow, and how we trade based on this, because recently hedge funds, institutions, large, important market makers and investors have been getting the data before retail. They've been getting the data before it's actually released. So if you get a big sell tomorrow, it's probably a bad sign. If you get a big rally tomorrow heading into Friday, that's probably a good sign for Friday's jobs report. Take a listen to what Adam Parker says about our markets and why he's not as bullish as he was before.
Joining us here on set this morning, Adam Parker, of course, Trivariate Research CEO and a CNBC contributor. Great to have you, AP.
Always good to be here.
You wrote about September, which does have the lowest average return, right?
Yes.
But you say you don't see signs that it's significantly a bad month.
Well, I was being, geeky and statistical significant there. It's the worst return with above average volatility. I think, as we've been highlighting the last few weeks, I think conditions are deteriorating. I'm not surprised. We've been talking about, I guess Dollar Tree, you take out the word tree, put in the word general. I mean, every week, you're sort of surprised something's down 20 when the other thing was down 20 last week. The consumer's slowing. It's been happening since mid-July. You've seen it across housing, autos, low-end consumer, Visa. I mean, I don't know how that's surprising. I think the incongruity that I see that's making me a little bit more cautious on equities and risk-taking is just simply that earnings estimates have not come down at all, particularly for Q4 in 2025, yet everyone expects the Fed to start a long, 8-cut path for the next year. So something has to give. Either the economy is a little bit better, it is a soft landing without a growth scare, and equities are great, or the earnings numbers have to come down more than they normally have to come down. And so that, I think, is where the tension is sort of lying. And the estimates are high.
I mean, I see that, although I think that it's up for debate as to whether the stock market at this exact level is based on a premise of 200 basis points of cuts, right? It's based on the direction of travel is easing because inflation's taken care of. It's not clear to me that if we say stocks price out 100 basis points of those cuts right now, where we necessarily fall.
My reaction to that is that I don't know.
Yeah, nobody.
But I know the market is ahead of the Fed. That I could say I'm pretty confident in.
The bond market is absolutely
Your comment was exactly why equities ripped in January of 23, because we knew we were kind of close to done hiking, and then eventually we would dream of accommodation someday. I think the reason it's tricky, and when I talk to institutional investors all day, it's because the last few times we've gotten the Fed to cut, it came with other goodies, fiscal stimulus, balance sheet expansion, and all of us, our era, have learned don't fight the Fed. You're an idiot if you fight the Fed. Well, this time maybe you do, because the market's really far ahead, and I'm not getting all that balance sheet expansion and incremental fiscal at the same time.
Well, we learned don't fight the Fed as a phrase,
right?
But in reality, people are saying, the first Fed rate cut, maybe you sell, because look at 08 and look at 2000, right? So that's
so I don't think the economy is going to deteriorate at the rate that requires 8 cuts, and then also not see a growth scare to earnings that's a little bit more than we're afraid right now. I think that's why I'm highlighting. So I do think the defense stuff makes sense. If I want to get super excited about anything, I think we talked about it a couple weeks ago when I was on, it's probably healthcare. I know it's acting defensive here, the services and other stuff, but I think it could also act as offense in the next upcycle, just in terms of the ability to improve the healthcare system through technology.
We're glued to NVIDIA, and it has actually turned around and is now up a third of 1%. It's significant, because it's so large. Right, at 2 point, where are we, 6 trillion or something?
Yeah.
Market cap, and also so indicative of the mood around AI and Gen AI and what that's going to do to our future. At 107, it's still up 117% year to date, but has had a sizable correction. I know you're a strategist, but do you have to have a view on this stock, to have a view on the market?
Well, I used to cover semiconductors for a long time. That's when we met years ago. I think you have to have.
What is your view on it?
I think you have to have context, right? I mean, the stock was $14 only 20 months ago, right? So the way I'm looking at AI semis is it's a giant party, and giant parties have huge hangovers, but the question is it still worth going to the party? Yeah, it is. Okay, it's going to be a hangover, but if you bought this thing in the $30 or $40, $50 range, you're still quite happy to have doubled. Okay, so it was a great party, right? And is the trend of AI semiconductors over? Of course not. We're going to be way higher on this stock in 3 to 5 years than we are now. We're in a kind of cooling off period. Margins have peaked. Every time a company gets too big, the DOJ investigate. I mean, you have all that kind of stuff that happens every time. But if you're asking, is the general kind of trend of compute, all that comes with it, slowing materially? No, it is not. Right, so I think you still want exposure, and if you're a growth manager, what are you supposed to do? Say, hey, I'm running your money for you, Sarah, but I don't believe in the AI semiconductor trend, so I have no weight in semis. Of course not.
So with that said, let me know what you think about this information down below in the comment section. Are you nervous about Friday? Do you think things are going to be good? What is your thoughts on the big data coming out Friday? Hit the like button as well as subscribe to the channel if you made it to the end of this video. You guys have a great rest of your day, and I will see you in the next one.